Debt Management Office will conduct a Treasury Bills primary market auction today with over 264.3 billion being offered. The traders at Axis Bank say they expect the market to trade with similar mixed sentiments today due to the auction. Tobechukwu Ikpe, Treasury Team member at Axis Bank, joins me for a midweek wrap on activities at the fixed income and FX markets. Tobechukwu, thank you for taking the time out to join us today. Let's get right to it. Bring us up to speed. But let's start with this auction today. What is the market expecting in terms of rates that are going to be offered and subscription levels?
Thank you for having me, Esther. So for the NTB auction today, as you said, there's a 265 billion naira on offer thereabouts. For the auction, market is expecting that rates will inch up by an approximate value of about 100 basis points from the closing rate of the previous auction, where it closed at 7%. This is due to the tight market liquidity conditions in the money markets. Market has had low liquidity levels this week, trading at around 47 billion in naira. So for the auction today, we expect the rates to inch up across the curve for the 90 days, 180 days, and 365-day bills on offer.
So what rate will we be looking at for the 90 across those three bills, starting with the 90?
90 days at the last auction, it closed at 2.75. So we expect it to go above 3% at this auction. The 180 days closed at 4%, and we expect it to rise also. For the 365-day bill, closed at 7% at the last auction. We're expecting a minimum of about 8% from the results at this auction. For the subscription levels, as you asked earlier, given the tight liquidity conditions in the market and market participants sourcing for funds to cover their auction bids, we expect a low bid to cover ratio, and that's part of what will drive the rates up. We might not even see a full allotment from the DMO at this auction because of the low liquidity levels.
Now, let's move over to the FX markets. Now, we've seen the reserves hover in the last couple of months between, excuse me, 38, I believe we're somewhere above $39 billion now. But it would seem that with the Smiths, the interventions by the CBN, it would seem that though, illiquidity persisted, but the CBN was very active, in meeting demand to some extent, but it would appear, I get the sense from the numbers we're seeing that maybe that has reduced. Can you confirm that to us? Because we're seeing the Naira depreciating or the NAFEX rates depreciating, and also at the INE window too.
So the CBN has been consistent with their interventions. They haven't reduced. It has remained stable throughout the year, and they continue to provide more as they see fit to the banks to meet all FX demand. But attributing the depreciation in the FX market, it can be attributed to the recent demand for school fees. We're approaching the September resumption season for lots of school children abroad, so parents and guardians are looking for how to source their foreign currency to pay for all these fees. It's expected usually during this period of the year. It's a trend we see, and we see the rate to stabilize once we cross into September.
All right. Let's hear your forecast for the trading for the rest of the week. And this is back to the fixed income market now. The trend we've seen since Monday, and of course, what we could see the week ending at.
So the fixed income market trading there will largely depend on liquidity levels and the results of this NTB auction. So if rates rise and liquidity levels remain tight, we expect continuous bearish sentiment, although with not a lot of trades being consummated because of the liquidity to fund the trades. For the bond market, we expect the same thing, cautious trading with bearish undertones. And for the FX market, we expect that rates will appreciate slightly towards the end of the week.
I'd like to hear your thoughts and perhaps what you've been discussing amongst yourselves as traders. The U.S. Rate hike that's coming, I believe that's today. It's supposed to be a significant one. What is that? How are you, processing that oncoming rate hike? What could that mean for our markets and, of course, investors who are looking to emerging markets too?
So for investors looking to emerging markets, the expected hike from the U.S. Fed rate has already been priced in. The emerging market bonds, their foreign currency bonds, have witnessed huge slippage from the beginning of the year due to the Russia-Ukraine war and the tightening of global financial conditions. So all these has already been priced in. We saw the bonds of emerging market countries like Nigeria, Ghana, Angola all slip, even over in East Africa too, all slip from year to date, but recently they've all stabilized at the support level because the expected tightening from the US is already priced in. We don't foresee any further impact by this tightening.
Okay, we'll leave it there. Thank you, Tobechukwu, for bringing us up to speed on markets. So thank you for your time. Tobechukwu Ikpe, Treasury Team member at Access Bank.